So at this point, banks are left holding these liabilities on their balance sheet, and they were not intended to hold them long term. And there's a thing we call fair value accounting. Anybody heard of that out here? Been watching the markets, fair value accounting? There's this thing called fair value accounting that requires that assets on the balance sheet be marked down to market, in spite of the fact that you're not going to sell them. So imagine if all of us in here lived in the same neighborhood. We owned a house, and all of our houses were valued at $200,000 each. But for some odd reason, Jim here had to move, and he fire sold his house for $100,000. The rest of us in the neighborhood, we don't really want to sell our houses, but the government is, in other words, telling us that even though we don't want to sell our houses, but because we live in the same neighborhood of Jim, we've got to mark down our house to $100,000. So that's not quite fair, even though they call it fair value accounting. Now, if this is a room full of accountants, they probably would have started throwing the stones right then. But so this can be very tricky because lenders are used to looking at debt as a long-term, intrinsically valuable asset, which means they can hold it long-term and they can realize the value that way. So these banks were scrambling week to week to try to figure out how to mark these assets down. Every time they mark the assets down on the balance sheet, they have to go out and raise more capital. So week to week, you would hear about these massive write-downs, and then you would hear about banks scrambling for more and more capital, right? And that was because of mark-to-market accounting. Now, I wrote in a briefing report over a year ago that they should have suspended mark-to-market accounting. If they would have suspended that accounting rule, you would still have the Lehman Brothers in the marketplace. You still have Bear Stearns in the marketplace. You still have a lot of these financial institutions that have collapsed still in the marketplace. Now, that sort of describes what was going on, at the end of last year and even coming into the beginning of this year. Let's fast forward to today and see where we are. And oftentimes, the people that I speak to on Wall Street, our firm deals with a lot of investment banks. We used to work with Lehman Brothers. We used to work with a lot of the institutions that have shut down. I speak to these guys on a weekly basis, and quite frankly, a lot of people feel like they are trapped in a nightmare that just will not end. We feel like we're in some kind of a horror movie where no matter what we do, the monster just keeps coming. Every time you turn around the corner, you see Jason there. He just keeps on coming. And the feds have done everything that they can. They pulled out all the stops. They've used every tool in the toolbox. They've even created some new ones that we didn't know about. They've cut interest rates. They gave out tax rebate checks. They've created special programs to provide liquidity. They've even bailed out banks. But still, we have not killed the credit monster. More than 9% of all single-family homeowners with mortgages are now a month in arrears or facing foreclosure. We have lost every major investment bank in the United States. Large financial companies, AIG, Fannie, and Freddie, have all been nationalized. The government now controls 80% of the mortgage market. During the boom in easy credit, the financial wizards of Wall Street created credit default swaps. Have you heard about those? You heard about the credit default swaps? Which are agreements that ensure the purchaser of default on credit by select companies and institutions. Now, this market lacks transparency, and it's highly unregulated, which allowed speculators to come in, and they would buy these agreements in spite of not even holding any of the debt of the underlying company. So the CDS market has now ballooned to a $62 trillion marketplace. There are $62 trillion in credit default swap agreements that have been created. This is a massive financial event. $1.5 trillion of that marketplace actually belonged to Fannie and Freddie. They were linked to the debt of Fannie Mae and Freddie Mac. That's $1.5 trillion in credit default swaps. And if Fannie and Freddie would have failed, it would have triggered $500 billion in payouts to companies if they did not get taken over by the government. Bear Stearns and AIG, they served as counterparty in a lot of these transactions. And they would have triggered a massive financial event if they would have not been rescued by the feds. Now, however, the Fed's decision not to rescue Lehman Brothers has led the market into uncharted territory. Over the last year, money markets have swollen to $3.5 trillion, which explains that investors are sitting on the sidelines and just waiting for the market to come back. Lehman had $800 million in debt through the money funds, and all of this has now been written off as a result of their failure. Subsequently, this crash has led to less confidence and is one of the primary reasons that short-term funding markets are now completely locked up. In other words, money market investors saw that the government was not willing to save everyone. And if they were not going to save everyone, money market investors hit the sidelines because they got afraid. And this is what's causing this deep frozen credit market or deep frozen money market that we now have. Now, everyone I speak to, they want to know, when is this going to be over? When is all this going to end? And unfortunately, I'm a little less optimistic than most about when we're going to actually end all this. And I don't think it will end in the near term. I think we've gotten into a spiral that could take years to actually pull out of. I mean, the financial crisis has sparked events that are now leading to an economic crisis with a global reach. So the main question that I hear a lot of times is, are we in recession? Are we in a recession? Now, the answer to that question depends on who you go ask. Now, most economists define a recession as 2 consecutive quarters of contraction in GDP growth, or gross domestic product. That's 6 months, 2 quarters of contraction in growth. Some of our large trading partners, Japan, Canada, Germany, and France, have all posted at least 1 quarter of contraction in growth. Several countries throughout the world right now this morning are in recession. There's an old joke that my grandfather told me once. He says that if your neighbor just lost his job, then it is an economic slowdown. But if you just lost your job, then it might be a recession. Now, unemployment is at 6.1% currently, which is up from 4.7% this time last year. Unemployment peaked at 6.3% during the previous recession after the dot-com bust. So we're not really that far off from reaching the same levels that we reached at a peak in 2001. Financial companies accounted for 25% of the new jobs that were being created through financial companies. So I expect further pressure in the jobs market going forward because many of the financial companies have eliminated jobs that will not return. A lot of those securitization platforms that have been shut down, they will never be reopened. The financial sector is compressing. And after we get through this cycle, the financial sector will appear much smaller than it was before. During the 2001 recession, there was never 2 consecutive quarters of contraction in GDP growth. So now we have to wonder, are we really measuring recessions the right way? You know, American GDP is currently supported through a growing channel of exports and unprecedented government spending. But consumption, which is the main driver of the economy, is down dramatically. In addition, there are often large revisions to GDP figures. So we hear these things in the market, and a lot of times they get revised much later on. Oftentimes, we don't even know. The average consumer doesn't even know that GDP has been revised down. One of the things that I like to consider, or what I like to look at as a measure for recession, more so than GDP, is GDI, gross domestic income, and that's per individual. Now, gross domestic income has only risen 10 basis points since the 3rd quarter of 2007. Now, that's well below the 1% gain that we've seen in GDP over the same time. Stagnated income growth combined with rising unemployment confirms that we are definitely in a recession. So the question really becomes, how deep will the recession be?